Kong shares of dual-listed Chinese companies. Yesterday, this was happening. They fell sharply overnight after fears reemerged of potential delisting in the United States. Eunice Yoon joins us now with more. Hi, Eunice.
Hey, Joe. Well, Chinese and Hong Kong shares actually rebounded, but it all started out as a very brutal day, especially for dual-listed shares for Chinese companies. And this is after the SEC had named 5 U.S.-listed ADRs of Chinese firms that could be delisted if they don't provide enough information and access to audit documents. Now, those 5 companies all responded. Beijing said that it's looking forward to maintaining trading on the NASDAQ. ACM said it's committed to meeting the SEC's requirements. Zylab said that it would find an accounting firm that satisfies the SEC audit. HUTCHMED, a little less committal, saying that it was going to continue to evaluate all strategic options. And then Young China, which owns KFC as well as Taco Bell here in China, said that it may have to delist from the NYSE in early 2024. Now, the SEC's announcement renewed fears that even more Chinese companies that are listed in the U.S. are going to have to follow suit. The SEC in December had identified a total of 273 companies that were at risk, hadn't mentioned any names, but this has been a long drawn-out battle where the U.S. has been wanting to see the books of these Chinese companies listed in the U.S. China, though, bars foreign inspections of local accounting firms. The Chinese regulator, though, had said that it was confident that some type of agreement could be reached. It didn't necessarily calm investors down in the United States. But today, on its social media account, the CSRC said that it made positive progress with its U.S. counterparts. And what really boosted sentiment here was a local media report that talks on the audit were moving relatively smoothly and that a consensus would be reached soon. Sentiment, though, still pretty fragile, though, for a couple of reasons. One, we had some news on Didi Global. There are some reports now that Didi has to suspend or is already deciding to suspend its Hong Kong IPO plan because it didn't meet the demands of the Chinese regulator for the cybersecurity review. That's hitting sentiment. And then also the fact that Norway's sovereign wealth fund said that it was excluding the sportswear company from China, Li Ning, has also raised concerns that foreign investors are going to look a little bit more closely at a lot of these Chinese companies as a review and consider their ESG.
It's going to do well. Baidu could do well, but that doesn't mean that their stocks can translate into doing well. I think that the President Xi does not like capitalism, and he is a return to the old style.
Is there a price, though, at which you would buy into any of these companies? I mean, we're looking at a screen right now.
Do that? Why would I do that?
I'm just asking the question. I mean, you can make the argument that at some point the price is low enough that the risk that it continues to go lower is reduced.
I could do that, but that's irresponsible of me to do that. I can't recommend buying stocks in a communist regime that is a totalitarian dictator who's not just human rights, but is doing much more than that to be able to solidify his power. I think it's irresponsible for me to come out here and say, you know what, at 108, it's fully discounted that the man is a terrorist dictator.